wanted to get on here and do like a walk style, rant style video where I think Bitcoin is headed in the next couple of months and how that ties into our cycle theory and taking profits in this bull market. Bitcoin right now sitting at around 115,000. We're most likely going to be getting a push into September, and that's mainly because of global M2 and where that's headed right now. Global M2 is in an uptrend, so ever since around February of 2025. Also going to catch a lot of people off guard. A lot of people have been subscribing to the fact that Bitcoin and other assets always have to go down in September, which is not necessarily true. Indexes can go up in September. And I've been tracking this theory that a 4-year cycle gets cut by 2 months each cycle. And so if that's the case, that could coincide with Bitcoin having a very, very, very strong rally end of September into October. I think early October could mark the top of the entire cycle. I wanted to kind of talk about my trade, a 3x Cardano trade, and I'm in a 20x Bitcoin trade. And I've been managing those trades for the past 2.5 to 3 weeks. Bitcoin trade just turned green. The Cardano trade is still red. In June, it was 2 trades. Did a $5,000 trade in June, a $6,000 trade in June. And then I made about a $9,000 trade in July. Like the swing trading strategy, because you only have to be right a couple of times. I think a lot of people get caught up in the day trading where they're trading, and high frequency trading could lead to lower probabilities of a win rate, right? So if you're trading higher frequency, you theoretically have a lower probability of making that trade. So when you're swing trading, you only have to be right a couple of months out of the year. You only have to be right a couple times out of the entire year in order to actually make money. For example, this one person, her name is Tori Trades. She only took 14 trades the whole year. She made $300,000, right? So you don't necessarily, it depends on your sizing, your positioning, but you don't necessarily have to be trading very frequently to make a lot when you're swing trading. So that's why I swing trade, and that's the reason why I'm sizing up in this position. When you're trading, it's not about what you can make. It's about what happens if you lose the money, right? That's the most important thing. You have to be thinking about what happens if I lose this money right now when you're placing a trade. So what I've been doing the last couple of days has been I've been pretty much trying my absolute best to mitigate risk as much as possible around these 2 trades that I placed, so that I have the highest probability of making the trade. So, for instance, the Cardano trade originally was a 4x trade. I moved it. My liquidation was at 60. It was at around 60 cents, 61 cents. I moved it down to a 3x trade because, looking at the chart, Cardano has consistently drawdowns from $1.20 to like 51 cents. I mean, it happens so frequently actually on the chart that I'm like, okay, let's just say, for instance, this happens, put more money in and lower my leverage ratio, my margin ratio, so that my liquidation goes lower. So you always have to plan for the worst. I said a take profit for around $1.60. The reason why I said that is because, again, I've been doing a lot of charting recently, and most of the time when Cardano breaks out, it has around a 50 to 60% move. But I think right now we're most likely going to get a 70 to 80% move. For instance, when Bitcoin went from 74,000 to 109,000, it went from 34 cents to $1.20. So That's approximately a 200% move or a 250% move. This is the blow off top. I'm expecting bare minimum Cardano to go up around 70 to 80%. Obviously, it can go back to $3, but that's where I'm going to cut the trade. That'd be a significant amount of profit for me if it went up to 70 to 80%. But remember, it's not about how much you can make. It's about the worst case scenario and how much you can lose in that trade. So that's what you have to think about when you're trading. It's not always about what you can make, because that's how a lot of people get stuck. That's how a lot of traders end up losing money, because they're only thinking about what they can make instead of planning around how they could mitigate risk, maybe potentially cut a loss, maybe set a stop loss, so that they don't end up losing too much money, or they don't end up losing all their previous gains, or round tripping, right? So that's kind of what I'm thinking about. I do personally think that Bitcoin is most likely gonna pump from 115,000 to 130 the next couple of weeks to a month. Yeah, that would make a lot of sense, because a lot of people are expecting it to be bearish in September, but we still have global M2 money supply moving up very high. I mean, it's been moving. It's been, obviously, like we discussed earlier, it's been moving up for the past 6 months, and right now it looks like it's been peaking at around 130 to 140,000 Bitcoin, right? And historically, Bitcoin follows M2 money supply with a 70 to 90 day lag, and so that's what I'm expecting. Obviously, it doesn't have to happen. Obviously, we can get another push up in November, December, like we always do. But if it doesn't happen, don't be surprised, because we could be getting an early cycle top. I'm not calling for early cycle top, but I'm saying, as in, we could be getting a cutoff at around late September to early October because of global M2. And so with that being said, it's kind of off topic, but I also want to take the time to talk about kind of like the history of Bitcoin itself. And I kind of want to remind you guys that Bitcoin definitely is a great asset. I definitely do think that it's very smart to take your money from crypto or stocks and move it into real estate at some point in the cycle. Because I do think that real estate has been nearing somewhat of a bottom. I think the interest rates have been at around 6.5% to 7% for a while, and that's been a great buying opportunity. I personally have gotten 2 properties in this little kind of like real estate downturn we're in. One in February and one this month, actually, or last month in July. So the reason why I'm talking about real estate right now is because a lot of people would get caught up in new assets. I want to take the time a little bit to talk about the 18.6 year cycle and how that can coincide with a major crypto crash if we get one. I'm not calling for a crash, but what I want to talk about is the correlation between very, very heavily traded risky assets and the potential of 80 to 90% drawdowns because of the 18.6 year cycle we're in. Take, for instance, 2000s bubble, right? There was a dot-com bubble. There was a lot of speculative trading. There was a lot of people calling for higher prices on these stocks. But we were nearing the top. Remember, 2000, 2001, we were at the top. What happened to QQQ? It dropped down 87%, right? So I'm not saying that Bitcoin's going to do that. Obviously, it can't keep going. It doesn't have to drop down 87%. But just to let you guys know, I know there's a lot of new traders here, and I know there could be a lot of new investors in general Time, I personally think in my trading strategy, time is more important than price. The history of an asset is more important rather than the price of an asset. That's what I mean by time is more important than price. The reason why I'm talking about Bitcoin being potentially, having a drawdown and correlating that with the early 2000s bubble and dot-com bubble is because I want people to realize that this is a relatively new asset class, and there's a lot of volatility in new asset classes. So it's not always only up. When you have some profits, maybe consider taking that out and moving into something like VOO in a simple index fund, or maybe save up for real estate. Because I do think that, remember, time is more important than price, and the historical data of an asset class is more important than the price. Real estate, for instance, has been considered an investment for the last 300 to 500 years, and it's been considered an asset for the last 4,000 to 5,000 years. So that's why it's important when you're investing to look at the historical data of an asset rather than just saying, okay, this is the new hot thing, this is Bitcoin, this is Solana, this is whatever, this is Tesla stock. Because you have to understand the importance of the length of time at which people have considered a specific thing to be an asset, if that makes sense to you. Because that will give it relative safety as opposed to something that's newer. So that's why I'm just letting you guys know that's what I'm personally doing. That's what my brother is doing. That's what most people I know are doing. They're moving their profits into safer assets at the peak rather than keeping it all in cryptocurrency or other speculative assets for that matter. That's kind of like what I wanted to say about, the current cycle we're in and how that relates to cryptocurrency, the 18.6-year cycle. There are cycles within cycles. So there's a 100-year cycle, there's a 18.6-year cycle, and there's a 4-year cycle. Just to name a few, right? Those aren't all the cycles, but just to name a few. And within those, there are particular periods in those cycles where asset classes are most likely to move up, and there are particular periods within those cycles where assets are most likely to move down. Okay, kind of like the general thesis behind cycle theory and how you can relate that to when you're going to buy an asset rather than relating the price of an asset to its value. Because the price of a stock or real estate or a commodity, personally, I think is less important. I think the time that it's spent at a specific price is more important. So that's what I mean by time is more important than price, and that's why cycle theory is important. That's why 100-year cycles are important. I'll give you an example. Let's just take, for instance, gold. If gold was trading at $50 for 50 years, would you buy it? No, you wouldn't buy it because it hasn't moved for 50 years. It's just an example. Obviously, gold has been going up, but you wouldn't buy it because it hasn't moved for 50 years. So that's why time is more important than price. Because if an asset class doesn't move up for 50 years straight, there's no reason to buy it until it starts to make a move upwards. And if it breaks that trend, but until it does that, it's a waste of time or a waste of money or a waste of investment. You're just speculating off a very low probability. So that's kind of my thesis. That's why I think cycle theory is important. That's why I think 18.6-year cycle is important, because we have been moving up for quite a while in stocks and real estate, right? I personally think that real estate is going to keep going up until 26 and 27. indexes are, and Bitcoin for that matter, is most likely going to start to make a move down the latter half of the year. And that's just based off of time, not based off of price and what it's done in the past, and not where I think the price can go, right? Because that's less important. So anyways, that's what I wanted to say. Everyone go check out those trades on trade entries and exits on the BullTheory Discord. And like and subscribe this video. Join our community so you can get rich, so you can receive the weekly newsletters, and you can receive our educational videos just like this so you can get rich. It's not financial advice. I'll see you later. Open your damn laptop and subscribe to BullTheory.